Today, financial pressure reports for May 2024, episode 4, property investors. Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. So this is the fourth in our series of shows relating to our May 2024 stress analysis. And in today's show, we look at property investors, very important sector of the market, of course, and one where there is a lot of mythology and not much in the way of real data. Just to remind you that our sequence of shows over the last few days started with an overview of the May results, and then we've done mortgage stress and rental stress in quite a lot of detail. Today we're doing investor stress. This show will then cover the overall financial stress analysis, and finally we'll look at postcode analysis, where we'll look at viewers' requests for individual postcodes. And if you have an individual postcode you'd like me to look at, then put it in the comments below and I will try and cover it. Anyhow, in today's show, I want to look at the rental stress story. And just to start this, let me remind you that we look at stress in cash flow terms, and stressed investors are defined as investors with cash flow pressures. In other words, there's more money going out than coming in. That's a cash flow measure. And we also incorporate if they have an aspiration or a need to sell a property. So those are the two things that are incorporated into our analysis for stressed investors. So let's start by looking at the summary data, and this is the stacked ranked count of stressed investors, and it's worth just saying that this is actually the count of stressed investors, not individual investment properties. So postcode 2065, which includes Crow's Nest and Greenwich in New South Wales, has around 5,500 stressed investors, and that's 2/3 of those who are investing in difficulty from a cash flow perspective. And then postcode 3000 in Victoria at 59% or 4,300, followed by the postcode 2145 Wentworthville, which includes Greystanes, Pendle Hill, and Westmead, with 39% or 3,700 households. Then we go to Bundaberg, postcode 4670, with a quarter of investors who are stressed, more than 3,400. Then we go to Fortitude Valley, postcode 4006 in Queensland, including Newstead. And that's where we find 61% investors who are stressed, with 2,800 actually under difficulty. Then we go to Coomera, postcode 4209, including Upper Coomera and Widow Vale, with 31% or 2,700. Another postcode up in Queensland at Surfers Paradise, 4217, including Main Beach and Isle of Capri, with 41% and 2,769 households. Then we come back to New South Wales, postcode 2031, Randwick and Clovelly, with 50%, half of households in the stressed investment category, with 2,600, followed then by Hornsby and surrounding areas, Hornsby Heights included, 2077, with 43% or 2,649. And then we go to DY and surrounding areas, North Curl, for example, with postcode 2099 and 47% or 2,600 stressed investors there. And then we go to Surrey Hills and Darlinghurst, 2010, with 57% or 2,569 households in stressed investor mode. Then we go to Lane Cove, 2066, including Lindley Point and Northwood and Riverview, 41% or 2,560. Then back to Victoria, postcode 2141 South Yarra, 46%, 2,424. And then back to postcode 2000, which includes Dawes Point, Haymarket, Millers Point, Sydney and the Rocks, 52% or 2,400. And St Kilda, postcode 3182 in Victoria, with 59% and 2,373 in stressed investor land. So now what we're going to do is to look at the mapping of stressed investors. Again, this is quite a powerful way of looking at the detail and showing once again the distribution is not always where you think it might be. So we start in and around the postcode in the centre of Sydney, postcode 2000. And as I've already hinted, postcode 2000, of course, has quite a high levels of stress, particularly close to the city. And investors are finding it hard to cover the costs of running investment properties in and around here. As we pull out, we can see there that there are hotspots. Lane Cove, Wollstonecraft, 2065 stands out. North Bondi and Bondi Beach, Randwick, Waterloo, Zetland. Lane Cove. As we pull out further, we can see there that Ryde, North Ryde, Epping, South Wentworthville and Pendle Hill and Westmead, and down towards Brighton Le Sands, Randwick. And so the story goes on. And the fascinating thing about this is how the distribution of counts actually are quite spread. It isn't just in the West. There are areas in and around the city where property investors are struggling. Now, that's a combination, of course, of very high prices to buy property, but also the fact that there are some limits on how much you can put your rent up because, of course, people don't have the cash flow to meet even higher rents. Now, in contrast, if I then look at the investor stress as a percentage of investors, you can see here that in the centre of Sydney, there's quite a lot of pressure. And Chippendale in particular, 2008, is a particular hotspot at the moment. And that's partly because of the costs of acquiring property there relative to the ability to be able to actually command income. But around the central areas of Sydney, whether you go towards the Vaucluse end of things and down towards Bondi and Randwick, or whether you go north up towards Artarmon, Lane Cove, and even North Sydney and McMahon's Point, there are considerable pressures in investors. And in fact, quite a few investors in my surveys are looking quite seriously at escaping from some of their investment properties. In the inner west, of course, there are areas too where there's a problem, 2130 and 2049, Strathfield, 2136 and Enfield. As we pull out further, we can see that Parramatta is a bit of a standout, as is Willoughby further to the north. And interestingly, over towards the west, places like Blacktown, Fairfield, Campbelltown just aren't registering as much stress on a percentage basis. So the takeout from this is that property investors in and around the centre of Sydney are actually more under the gun than many of them would probably suspect themselves. And that's because quite often they measure their returns not in terms of cash flow, but in terms of capital appreciation. Question, of course, is, will the capital appreciation continue? And capital appreciation is fine in theory, but if you can't cover the costs of the service charges and the mortgages and the other maintenance and repairs on the property, then you have a problem. If I then go to postcode 3000 in and around Victoria, centre of town, of course, as you perhaps would expect, the stress count is very high for investors, as it was for those in the rental sector. It's sort of a yin and a yang, really, isn't it? South Bank is high, South Yarra 3141. And as we pull out, we can see that there are some hot spots down towards St Kilda. And generally, we're in the yellows, so the population density is reasonably high, but not necessarily as high as some other areas in the country. And overall, the investor stress starts to bite down in Frankston and Casey. We saw some of the reasons for that earlier on because of the high pressure on the rental end of things in those same areas. Turning quickly to the stress investor story on a percentage basis for Victoria, again in the centre of Victoria, centre of Melbourne, postcode 3000, there's a problem. And that's true in South Bank and South Melbourne too. As we pull out, we can see that going further south towards St Kilda, again, same pressure there. A lot of stressed investors as a proportion of all investors. Park Orchards, I noticed, 3114 is a bit of a standout as well. And as we pull out, we can see that there are odd areas where there is pressure, but a lot of the pressure with regard to investment properties is actually in a relatively small number of postcodes closer in. Interestingly, it is precisely in these areas where more investment properties are coming on the market at the moment. Go to Brisbane and look at the investor stress count. Fortitude Valley and Queensland's central postcode of 4,000 at Brisbane City are sitting there in the orange. So they have significant pressure. Of course, a lot of high rise there, a lot of very expensive property, and a lot of big service charges going on there at the moment. As we pull out from that, things don't look too bad with regard to investors. That's because at the moment, in the Queensland area, there's still significant demand from people who can afford to pay the rents that are on demand. Although in some areas, as we pull out 4300 and then down towards the Gold Coast, 4207 is a bit of a different story. 4209, there, of course, the rentals are actually significantly higher. And that's because there's huge service charges on some of those high-rise apartments that have been built on the Gold Coast. And in fact, many of those investments are underwater from a cash flow perspective. Also, I note that Toowoomba is again showing as another area where investors are potentially having an issue, as areas up in the Sunshine Coast as well. Turning to the investor stress on a percentage basis for Queensland, starting on postcode 4000 in the centre of Brisbane, you can see there that the centre of Brisbane has an issue. Again, the population density is somewhat lower, but the percentages are quite high here. As you pull out further, not too many really critical issues close to Brisbane. And as we come out and look more broadly down towards the Gold Coast and up towards the Sunshine Coast, again, not dramatic. And the basic takeaway here is that many investors are still able to command quite significant rent rises, and so they don't feel under too much pressure, and their cash flows are relatively benign. Go to Adelaide and start in the centre of Adelaide, again looking at the investor stress count. There are small numbers of stressed investors, but the demand is quite high, and the absolute level of rents are lower in South Australia relative to elsewhere. So the levels of rental stress and therefore investor stress tends to be somewhat lower, particularly away from some of the coastal areas. Not too many surprises there, really. In Adelaide, on a percentage basis, not a huge count of stressed investors on a percentage basis. No surprise seeing what else we've seen today. But it is worth just noting that a little bit more pressure towards the coast rather than inland. And really, there isn't much more to say about this particular area. There's still strong demand for investment property, and property investors still seem happy to buy. By the way, a lot of property investors in and around these areas are interstate investors. If I go to Western Australia and look at Perth, again close in, the stressed investor story is not too severe simply because of high demand and the fact that the rentals are going up quite a lot. So in the West at the moment, quite a few investors are doing okay, which is why we're mostly in the yellow bands or better. And even Wanneroo, who's been a bit of a problem in some of our other analyses, isn't looking too bad. And even if we go out towards Rockingham and down to the south, but I would highlight the fact that Mandurah seems to be a little bit of an outpost there where there are some significant pressures on investors. Again, many of those bought many years ago. Capital appreciation has been negative, and the ability to command stronger rents is also limited. Across to Perth and looking again at the stress percent for investors, you can see here in the East Perth area, 6004, and down to Rivervale, 6103, we have some pressure. Other than that, in and around Perth, it's all looking reasonably manageable. Lots of demand for property, lots of ability to hike the rents, and therefore not too much of an issue. A few hot spots to note, but on the whole, even Mandurah is not looking too bad. And in Hobart, we look in and around Tasmania, rental stress we saw wasn't too severe, but some investors are still struggling. The demand, of course, is still quite strong, but the ability to put rents up is somewhat limited now, simply because of wages growth being somewhat limited, and wages growth in the Tasmanian area tends to be lower than the national average. So areas around 7,000 and 7,008 tend to be a little bit higher, as across places like Belrive and Mornington as well. And then we're going to look at the investor stress on a percentage basis for the Hobart area. And again, small numbers in a percentage basis. There's some pressure, but it's not as high as, for example, in Sydney or in Melbourne. Now, of course, the final lens that we need to turn to when we think about investment is net investment yields. Now, net investment yields is the difference between the cash flow in and the cash flow out. So it's not like gross investment, where that's comparing the theoretical purchase price with the theoretical full rental price. That's distorting. So this is an example of net investment yields for postcode 2000, and it's worth highlighting that the reds are underwater and the blues are actually above water. So in and around the centre of Sydney, you can see here that net investment yields are predominantly difficult, whether you go from Vaucluse via Bondi to Paddington to Annandale to Haberfield. If you go north, Gladesville and places like that have a real significant issue. Homebush, Parramatta. Northbridge is a bit of a standout. Strathfield South isn't too bad, and Kingsgrove works. So it does vary, but you can see here that there's quite a lot of areas in and around where the true story of the investment yields is pretty frightening. Now, if you believe that you're going to make massive capital appreciation, then you might still hang on, although I'm a bit skeptical of future price growth, as you know. But if you're in Campbelltown or Liverpool or Fairfield or Cumberland, anywhere around there, or up towards Hornsby or in the Northern Beaches, chances are your investment property is underwater from a cash flow basis, and that is a problem. And finally, we're going to look at net investment yields for Melbourne, and it's interesting to see that in the centre of town, the net investment yields are not necessarily too bad, but as you pull out, you can immediately see that surrounding the city itself, net investment yields are pretty chronic. In other words, you're losing money from Toorak to Hawthorne to Darwin to Marybeck to Brunswick, Maidstone to Tottenham to Wyndham. And this is the problem in the Victorian context. A lot of the properties for investment, other than perhaps in the centre of town, are negative in cash flow terms. There are a few hot spots and bright spots, as you can see in the blues there, but nevertheless, overall, the story is pretty concerning. No reason to expect this to change, which is why we continue to see quite a few investors looking to get out in Melbourne. Melbourne net investment yields are the worst in the country. Now, if we turn to look at the net investment yields in and around Brisbane, compared with Victoria, where it was mostly negative, in and around Brisbane, it's mostly positive with quite strong blues. So people are actually making a reasonable return. Reasonable, well, above 0.9% at least. But if you look, there are a few hot spots where things are not looking as good. And as we pull out, you can see there that around Ipswich, for example, there are some questionable returns. And as we go down towards the Gold Coast and places like that, in contrast, the returns are quite strong. Not surprising given the fact that there's a lot of demand. On the other hand, places like Logan, for example, a little bit more negative. And as we look out towards the west and Toowoomba, again, there are questions there about net investment yields. In the Sunshine Coast, not looking too bad. Now we're going to look at the net investment yields in and around South Australia with a focus on the centre of Adelaide. And as we pull out, we can see that the blues are quite strong, so people are making reasonable returns. There are a few areas where the returns are less strong. 5070, Woodville, for example, and to the south, 5039. And this is a very important chart insofar that it does highlight the fact that there are areas where people from a cash flow perspective are actually losing money. Now, if you believe in significant capital appreciation, you might hang on. If not, you might decide to sell. And looking at the net investment yields in Western Australia, in and around the centre of Perth, they're pretty strong, lots of blues. But places like Bayswater and Stirling, Wembley Downs, a bit more negative. And in fact, as we pull out, we can see a bit of a hot spot. Areas to the south around Melbourne, not too bad, but also a few where there are more suspicious things going on. Both to the north and to the south, Serpentine, for example, is one that stands out. And interestingly, the net investment yields in Mandurah are actually in the positive range, despite what we saw earlier on with regard to some of the pressures in that area. And finally, we'll just look at Hobart. In Hobart, the net investment yields are not too bad at all relative to other parts of the country. But as we pull out, we can see a few areas like 7012, where there are some indications of net investment yields in the negative range. So as we come to the end of this show, I'll just remind you again that we are providing DFA one-to-one services. It's available for an individual confidential discussion with me about a particular suburb. And I can't give specific financial advice, but I can talk about my data and what I'm seeing and the underlying trends. I can look at stress, home price trends, and also have a view of what's happening with regard to trends ahead based on my modeling. You can book a time. It's an hour for a Zoom or a phone discussion. And there's a charge involved simply because there's a lot of work to do this. If you'd like to book a time with me, we're booking 3 to 5 weeks ahead, and you can contact me by the DFA blog. So to sum up my conclusions with regard to property investment, there are significant variations depending on what type of property you invest in and what returns you're able to get. Unfortunately, many property investors are hopelessly optimistic about the returns that they actually do get, and of course try and offset against tax. But the truth is that many property investors are underwater in cash flow terms, and with less prospect of capital appreciation are beginning to sell. We're seeing that particularly in around Victoria, but other areas too. So we also note that people who have invested in units rather than houses seem to be doing less well. So it's a cautionary tale. If you're a property investor thinking of getting into the property investment game, make sure you buy the right types of property. As we close the show, in the next part of our series on financial pressure reports for May, we're going to look at the overall financial stress. In other words, at how this in aggregate terms is hitting families. So join me tomorrow for the next part in this series. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.